In this video, I'll be sharing the top 5 growth ETFs that you can invest in to potentially get higher returns. But it won't just be any random high growth ETF where it just outperforms 1 or 2 years and crashes back down. Okay. Instead, the ETFs need to consistently deliver high returns over the years. Besides that, the ETFs also need to have low expense ratio. Why? Cheaper is better ma. Lastly, it's also important that these ETFs have diverse holdings that cover as many sectors as possible. So, no thematic ETFs and no sector ETFs. For example, while tech is the best performing sector right now, this is not guaranteed to continue forever. So, we want to be well diversified to capture all the high growths. And with these criteria in mind, let's jump straight into the first ETF, the Vanguard Growth ETF, ticker symbol VUG. This ETF tracks the performance of large-cap growth stocks in the US. The stocks have both short-term and long-term growth in earnings per share and have a 3-year historical growth in sales per share. Basically, big companies that have and will continue to grow. This ETF has 221 stocks with a median market cap of $763 billion. The largest sector is in technology at 53%. Followed by 20% consumer discretionary and 8.8% in industrials. In the top 10 companies, you have the big tech stocks such as Apple, Microsoft, and Amazon. Interestingly, the pharmaceutical company called Eli Lilly & Co. also made it in the top 10 list. For the past 10 years, this ETF has given a rather high 14% annual return, while going up by an impressive 29% in the past 1 year. In return, this ETF only has a tiny 0.04% expense ratio, which means for every $1,000 you invest, you will only pay 40 cents in fees, which is super cheap. Finally, in terms of risk profile, Morningstar gives this a 4 out of 5 risk rating, which means while the risk is high, the holdings are decently diversified over 200 large-cap companies that have proven themselves to be successful. Next up, Invesco QQQ ETF or QQQ. This ETF is definitely one of the most established ETFs in the world. It tracks the performance of the Nasdaq 100 index, which holds the 100 largest non-financial companies listed on the Nasdaq. QQQ has a much lower number of holdings at just 101 companies and has a weighted market cap of $856 billion. The holdings are heavily concentrated in technology at 57%, followed by 18% in consumer discretionary and 7% in healthcare. As for the top holdings, you have the usual names such as Apple, Microsoft, Amazon, .com, Facebook, and so on. For the past 10 years, QQQ has delivered a very impressive 17% annual return, while also delivering a stunning 35% return over the past 1 year. Though, the expense ratio is a little higher at 0.2%, which means for every $1,000 you invest, the fee would come in at $2. But the good news is that there's another ETF called QQQM, which is also under the same fund manager. QQQM is completely identical to QQQ. They have the same holdings, they track the same thing, but it has a lower expense ratio of 0.15%. As for the risk profile, Morningstar rates QQQ at 4 out of 5 risk rating due to its concentrated stock positions. While this ETF can deliver higher returns, when times are bad, it can also drop by quite a lot. So be aware of this, yeah? Quick pause. Did you know that Tiger Brokers provides you with some pretty useful features to do stock research? To find that, you can open up your favorite stock, then at the top, if you tap on the tiny down arrow, you will see some useful info of the stock, such as the price to earnings ratio, price to book, price to sales, the 52-week high, 52-week low, and current dividend yield. Then if you head over to the financials tab, you will find a lot more info about the stock. For example, you will get a quick info of the latest earnings. Further down, you will see some estimates of earnings per share, revenue, and earnings before income tax for the next few years. Aside from those, you can also find some quick summaries of the company's financial statements such as income statement, balance sheet, and cash flow. They even show you a breakdown of how the company earns its money and where the revenues are coming from, all of which are definitely useful when doing stock research. So if you sign up using my link down below, find your accounts with 1,500 Singapore dollars, hold it for 7 days while completing 5 buy trades, you will earn $40 worth of Apple fractional shares, 1 free stock worth up to 888 SCHG, and an exclusive $30 Tesla fractional share. And on top of that, you will also get 0 commission trades for US stocks for 180 days and other markets for 365 days. So if you are interested, you can sign up using my link down below. With that being said, let's get back to the video. The next ETF is iShares Russell Mid-Cap Growth ETF, ticker symbol IWP. While the previous two ETFs focus on large cap stocks, this ETF tracks mid-cap stocks from the Russell Mid-Cap Growth Index. Mid-cap stocks are companies that have a market value of between $2 billion to $10 billion. These are the companies that have proven that they have a working business model, so they have a lower risk of failing, but they are not at the large cap stage yet. This ETF has 333 holdings, out of which 24% is in technology, 19.6% industrials, and 18.6% healthcare. Most of the top holdings are unfamiliar names, but interestingly, we have Palantir in the list, though it only has a 1.07% weightage. As for the performance, this ETF has delivered a slightly lower 9.72% 10-year average return, with the past 1 year going up by 17%. This ETF has an expense ratio of 0.23%. So for every $1,000 you invest, the fee would come in at $2.30, which is a little on the high side. Morningstar gives this ETF a 3 out of 5 risk rating. As mid-cap companies are still in the growth stage, they may offer higher upside potential. In comparison, large-cap companies may already be well established and may not grow as fast. Plus, because this is an ETF, you get to enjoy lower risk, since companies that underperform will just get smaller and eventually be replaced by bigger and better companies. The next ETF is the Schwab US Large Cap Growth ETF, ticker symbol SCHG. This ETF tracks the performance of large cap growth stocks in the Dow Jones. SCHG currently has 251 holdings and has an average market cap of $1.1 trillion. The holdings are once again largely concentrated in technology at 44%, 13% in healthcare, and 13% in communication services. You will again see familiar names in the top holdings, such as Apple, Microsoft, Amazon, Nvidia, and so on. Over the past 10 years, this ETF has delivered a high 15% average return, and in the past 1 year, it has gone up by 32%. SCHG has an expense ratio of just 0.04%. So for every $1,000 you invest, you will only pay 40 cents in fees. Morningstar gives this ETF a 4 out of 5 risk rating, which is similar to the other ETFs that track large cap growth stocks. If you feel that this ETF is similar to VUG, you are right. Both ETFs focus on large cap growth stocks, have around the same number of holdings, and have about 83% overlap in holdings. The main difference is that while VUG focuses a little more on consumer discretionary companies, SCHG focuses a bit more on healthcare companies. Lastly, we have the Spider Portfolio S&P 500 Growth ETF, ticker symbol SPYG. While the previous ETF tracks growth companies in the Dow Jones, this ETF tracks growth companies in the S&P 500. The stocks are chosen based on characteristics such as high sales growth, the ratio of earnings change to price and momentum. There are currently 225 holdings in this ETF, with a weighted average market cap of $1.2 billion. As for the sectors, 47% is in tech, 15.5% in consumer discretionary, and 12% in communication services. And once again, many of the top holdings are companies that we have seen before, such as Apple, Microsoft, and Amazon. The 10-year return of this ETF is at 13%, while the 1-year return comes in at 16%. As for the fees, this ETF also has a rather low 0.04% expense ratio. So out of a $1,000 investment, 40 cents goes to paying the fund manager. In terms of risk profile, Morningstar gives this ETF a 3 out of 5 risk rating. That's because the holdings are diversified across established companies that have a low chance of failing. As for the fund overlap, this ETF has a 79% overlap with VUG and a slightly larger focus on industrial companies. Then, if we compare this ETF against SCHG, there's also a similar overlap of 78%. But SCHG is a little more focused on the healthcare sector. But I guess the question is, with all 5 ETFs that seemingly look the same, which ETF should you go for? Okay, here's a table to help you better analyze this. You can choose the ETF in 3 different ways. 1. If you prefer an ETF that has shown that it can give the highest performance, you can go for QQQ. Looking at the chart, it does seem like QQQ has managed to outperform the others by a lot. Then it's followed by SCHG, VUG, SPYG, and the worst performing ETF is IWP. However, this doesn't mean that QQQ is the best ETF and IWT is the suckiest ETF. The reason this happened is because QQQ is a lot more concentrated in the top tech stocks, which happen to do really well during this period. Or 2, if you are looking for an ETF that has a higher upside potential, you can go with IWP. That's because with the recent advancements in AI, mid-cap stocks could potentially start to do well over the next few years. Or 3, if you just want to enjoy the high growth and yet have the diversification, you can go with either VUG or SCHG or SPYG. All 3 of them have around the same number of holdings and their top 10 weightage are also about the same. So those were the 5 best growth ETFs that could potentially give you higher returns over the long term. But which do you prefer? Do comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.